Hello, everybody, and the warmest of welcomes to another edition of The More You Know. It's the STANLIB Vodcast, where we discuss in some detail ideas and decisions and disciplines that are shaping long-term investing. And in this particular episode, we are going to mark a significant milestone, the 10-year anniversary of the STANLIB Enhanced Multi-Style Equity Fund. Now, it was launched in 2016, led by Rademeyer Vermaak. I'm going to talk to him in just a moment, and the Systematic Solutions team. And the fund was built around a disciplined, multi-style approach to South African equities. What do I mean by that? Well, blending data, valuation, quality, and growth signals rather than chasing the market's latest mood. So, a decade on, we're going to look back at how this fund came into being, the moments that really tested the process, and believe me, there were moments, and also what it means to stick to your guns in a volatile market, and just how discipline really matters in today's investment climate of geopolitical risk, of shifting rate expectations, and uncertain domestic growth. So, Rademeyer, a very warm welcome and congratulations, 10 years. That's either your tin or aluminium anniversary, I think, but we can talk about that a little bit later. We're going to talk about this fund, and it's divided into 5 very distinct chapters. And you're going to tell me in 2016 it all starts in London. Pick the story up for me.
Yeah, Jeremy. So I guess the story of the Enhanced Multi-Style Fund at STANLIB goes back quite a long time. It actually starts in 2007-ish in London, when I got my first taste and first sort of exploration into this world of systematic investing. And it starts with a very interesting book that I read. It's called Turtle Trading. And the story about the turtle trading is that there was this legendary commodity trader in the 80s called Richard Dennis. And he turned $5,000 into $150 million with his trading. And he had a partner that disagreed with him on what the source of his skill was. Richard Dennis believed that he would be able to teach anyone how to trade like he does. And his partner said, no, you've got an innate ability, a talent. It can't be taught. And Richard Dennis says, like they breed turtles in Singapore, I can breed traders. And so they had this bet where Richard Dennis recruited 15 random people off the street, a teacher, a fireman, a policeman, completely
with no prior expertise.
With no prior experience in the financial markets. And he taught them a specific set of rules to follow when they invested. And this is a legendary story because of those 15 people, 10 of them started or are still running some of the largest hedge funds in the world. And they each turned $1 million into $100 million. So it's an incredible story behind this Richard Dennis person. And I read that book and I said, I want to give this a shot.
What did you see in that book? Something would have ignited in your head.
So this book in particular is about trend following. So it's about identifying when a stock or a future or any asset is moving up and when to buy and when to sell. The key difference here and why it's an important part of the story is that this specific way of looking at the market only looks at one instrument at a time and its own time series, how it got to where it is today. So it looks at every instrument in isolation. So this way of investing has evolved into a complete set of a complete hedge fund subsector called CTAs, or commodity trading advisors. And it's a massive hedge fund industry that uses this methodology of investing in the markets. But that's only half the story of how the fund developed.
So you're in London, you've read the book, you see the opportunity. What's the next process before you come back to South Africa?
So I actually launched a hedge fund in London with a partner. And then it was early days in the hedge fund. The global financial crisis happened in 2008. Brokers closed down. It was absolute chaos. And then my wife fell pregnant with twin boys, and we decided we're going to come back to South Africa to raise the boys at home.
Before we get to South Africa, what lessons did you learn from that very turbulent time?
Oh, the importance of risk management. Absolutely. I remember it was such a strange time in London. I was working at an investment bank at the time, and I remember coming into the office then this one morning, October 2008. And when I arrived at the office, there was a whole desk of people still working. They each got called into the office. And whilst they were in there, security came, packed their boxes, and I never saw them again. That evening, went out to the pub, and there were literally people crying in the pub about having lost their jobs. It was a surreal time in the market.
And this is the stuff of movies. I mean, we've seen that
Yeah.
play out in real time. Just before we come back to South Africa, and obviously you would then have had a process of meeting South African investors, the book itself, do you think 10 years on it still has relevance, or do you think things have changed?
No, it certainly has relevance. I think there are important learnings from that serves as a foundation for potentially any investor, but that by itself is not enough. You need to continuously build on that foundation to something that is more robust than just that simple strategy.
Which we're going to get to in a minute. Do you still have a copy of that book?
I've actually got 4 copies.
Okay, so you come back to South Africa then. So that is London is done. Let's not forget the fact that you have twin boys. You arrive in South Africa and you then start the process of meeting South African investors,
Yes.
right? What are you trying to sell them or convince them of? And Rademeyer, how much skepticism do you meet with?
So, Jeremy, I guess the initial process in South Africa was trying to find somebody to join as a portfolio manager. And in that process, I encountered a very interesting and intellectual individual who told me about this academic paper that he'd been reading. And he didn't have the skills to test and to replicate what this paper was about. And that's where the second part of the philosophy and the process came about. Now, this paper was a paper about the low volatility anomaly by Haugen and Baker. And in essence, the way that this paper looks at the market is it takes all the stocks in the SA market at a specific point in time and ranks them by how volatile they are. And then it buys the stocks with the lowest volatility. And I figured, wow, this is such a simple strategy, but it's different than the time series strategy of the turtles. This is a cross-sectional way. So you're looking at all the assets at the same time. It's not one asset at a time. And so I built a spreadsheet to test this strategy, and I was absolutely dumbfounded by the results. So it showed that there is another way of creating and improving returns than just using the history of an asset class.
Can we just rewind a little bit? What is the determinant of volatility? How are you measuring that, and in order to achieve that ranking?
Oh, it's really as simple as measuring the standard deviation of returns over the last year. So it's mathematically not a complicated process to follow, but the process of ranking stocks by that single metric was incredibly powerful. And from there, I guess I started to delve into this world of cross-sectional investing, and there's a lot of academic research that backs this way of investing. And then I started to add more and more fundamentals to the alpha signal.
All right, so let's decode this then. So what type of fundamentals are you talking about? And just explain to us what you mean by alpha signal.
So alpha signal is basically the output of all of your work.
Okay.
Whether you do it systematically or discretionarily, it's
the consequence. It's what you've achieved.
It's what you've achieved. It's your decision tool. So how I get to, and how we get to our alpha signal in this enhanced multi-style fund is we're looking at a number of different fundamentals. So we downloaded the balance sheet, the income statement, the earnings revisions, all the potential fundamentals, the cash flow statement for thousands of stocks on the MSCI World and South Africa, all the way back to 2000.
Going back how far?
Going back to 2000.
Yeah.
To use that as the research data set for adding information to this low volatility anomaly. And I mean, the data itself was still buggy. We actually contacted the data provider a number of times. I mean, we've downloaded terabytes of data, thousands and thousands of data points. And we said, there's this stock in Brazil that in 2003 had an ROE of 300%. You know, is that correct? And the data provider would come back to us and say, how did you find this? We made a mistake here. We'll fix it. And so, you know, we were really on top of the data aspect of the calibration of our investment philosophy.
How did you decide which fundamentals were critical to add to the mix? You've given me a long list. I mean, are those themselves ranked?
Each alpha signal brings something different to the table. So if you look at valuation, so how expensive or cheap a company is, there are a number of different academic papers that backs this as a methodology or a strategy for investing. So if you look at valuation signals, you would need to look at the price and, for example, the book value of the company, or the forward earnings consensus, or the cash flow of the company to get a relative valuation. You also need to look at the profitability of the company, such as the ROE and the ROA, to determine what the quality of the company is, how much cash the company generates. So we really try to build as holistic perspective on every company as possible, using a very evidence-based and data science-driven approach.
Then you had to look at risk management.
Yes. The reality is that, and what came out of that process, this was still running in a spreadsheet. We just started to build better and better forecasting and scoring tools for evaluating which stocks we like and dislike. But when you build a portfolio, that's when things can fall apart. You can end up with a portfolio that is completely in financials, and then you are exposed to risks that you don't actually want to be in. So that's when I started to incorporate more and more risk management and risk controls into the stock selection methodology to build a portfolio that is holistically balanced but risk controlled.
What type of risk controls are we talking about?
So we do active single stock risk, active sector risk, and then through time, there were a number of different developments in the market that gave us learnings about improving the risk management in the fund. And one of these was Naspers, and how big Naspers was becoming in the index. And the Rand dollar exchange rate had such a massive impact on the Naspers share price that the realization came that we are actually exposed to the Rand dollar through Naspers, and that's not a risk that we actually want to take. We don't have a view on that. It's not a fundamental stock risk. It's a top-down macro risk. So how do we control for that? And so we developed a top-down macro risk management that also helps manage the overall risk of the portfolio. So quite a robust risk management framework.
So two things are happening at this point. You've got you've laid the foundation for all of this. At the same time, you're managing twins. So there's a lot of stress. The fund then is born in 2016.
Yes.
How did that happen? And what was the initial response to that?
So, Jimmy, yes, the fund was born in March of 2016. And I think the initial response was that clients said, let's see how this progresses. Let's see what comes from this.
At this point, it's a bit of an outlier, though. People, yes. Are you having to do a fair amount of convincing and education,
yes,
right?
Absolutely. Okay. It was very much about educating investors about what systematic investing is back in 2016. I think today, systematic investing is as well recognized as any other investment strategy or investment methodology out there.
But 10 years ago, something different, right?
Yeah. Absolutely. Absolutely. It was cutting edge and new then. I guess something else to just add to that is the evolution of the technology behind the fund. So when the fund launched in 2016, the entire process ran on a spreadsheet with VBA macros. Now, I could really program VBA back in the day. I was a real VBA wizard, if I have to say so myself. And to run the investment process once took 24 hours on a VBA macro. So I would literally come in the morning, hit the start button on the macro, and it would calculate for 24 hours before I would get the result. And I could then trade on that. I then converted the spreadsheet to a data science tool called R.
Mm-hmm.
And the same process that took 24 hours in a spreadsheet took 20 seconds in this data science language. So it just leapfrogged us into the next phase of research and development and improvement. And throughout this process, we were adding more and more fundamentals and more risk management, and we were just consistently improving the fund.
All right. So constant improvement, and then let's fast forward from 2016 to 2019, 3 years later, STANLIB comes into the picture.
Yes.
How did that happen?
So I joined STANLIB in 2019, and STANLIB bought the IP and fund from the previous company where I was employed. And so I started to use the fund at STANLIB, and STANLIB was starting to use the fund internally as well in some of the multi-asset solutions. And then I guess with STANLIB support and the benefit of having a big corporate and a solid base behind you is that I was able to, with the help of my team, again convert the code base from running on my laptop in a data science tool to running in the cloud. And the reason behind that was that we also wanted to build a global version of the strategy. And to give you some context on the immense amount of data that requires, on my laptop with this R data science tool that converted a 24-hour spreadsheet to a 20-second to run a global process, my laptop was running at 100% CPU for a week to get one portfolio. So we converted that to the cloud, and we did a number of code improvements, and that entire process now takes an hour. So from a week on my laptop to an hour in the cloud is a massive technological jump, and that gives us another leg up in terms of our research iterations and our improvements. So technology is so important.
How difficult was that global scalability that you were trying to achieve?
Besides the technology challenge of processing so much data, the investment philosophy was a very natural transition, and it worked exactly the same way, exactly the same investment engine, the same fundamentals that we used in the South African fund. We tested globally, and it all just worked as designed. I mean, those are really the fundamentals that drive the stock market.
But at that point, you were also, as the fund has grown and matured, you're also dealing with major market events. So let's pick on two of them. One was the Steinhoff affair.
Yes.
And I'm assuming that you would have paid a lot of attention to the pandemic. Let's start with Steinhoff.
So Steinhoff was a very interesting phenomenon, and I think experience for me in managing a portfolio and sticking to your guns. So Steinhoff was an absolute gem in the market. Everybody, and every financial analyst and every portfolio manager loved the stock. And I was probably one of the only fund managers that didn't have a holding in the stock, because the fundamentals that I looked at and that I look at said there are better stocks out there. Obviously, didn't pick up on the accounting fraud.
I was going to say, better stocks out there, or were you seeing inherent risk that others were not seeing?
No, I mean, we were picking up on risks, but through different lenses, not through a forensic accounting lens. I think that was so well obfuscated that some of the best accountants couldn't identify that ex ante or beforehand. So the fundamentals that we looked at said, we don't want to hold Steinhoff. There are better opportunities in the same sector, and we didn't hold any Steinhoff. But it was a tough position to hold for a very long time because the stock was doing well, and in every news...
And the noise, people saying, hey,
Exactly.
How do you fend that off?
But that's the beauty of a systematic process. It takes the emotions
Here's the data.
out.
Yeah.
Exactly. It takes the emotions out. It doesn't mean I don't have emotions, but my process is emotionless. Always rational, always objective. And I remember I was in Switzerland on an investment conference. It was December 2017. And I remember I went back to my hotel room after the end of the day, and I opened up my Bloomberg. I wanted to look at what my performance was on the day. And it was like, whoa, this is a massive performance. What's gone on here? And I ranked the stocks by the daily performance, and I saw Steinhoff down 99%. And I was like...
So red letter day in South African investing history.
It was an absolute Rubicon. And I think it validated and justified the importance of being able to stick to your guns despite swimming upstream from everyone else.
And the pandemic?
So the pandemic was of course also an incredibly turbulent period in the global markets. And I remember on the day of the pandemic, or the 16th of March was the day that the markets really tanked. And it was actually my birthday. And it was one of the worst performing days that the fund has ever had. I remember in the middle of the day, the fund was down 3% relative to the benchmark. That's a big number, Jeremy. This was crazy market moves. And the reality is that there were only two things you could do at that point in time. You could either go and buy tech stocks. That was the best thing you could have done. The second best thing you could have done was to do nothing and to trust your process. And so that's what we did. And a couple of weeks later, we had recovered all of that underperformance, which is another important proof point of keeping emotions out and sticking to your process through emotionally turbulent times.
We're coming to the end of this conversation. I want to look at where we are now, and I want to look at maybe the future. The fund is positioned as long-term, systematic, bias-aware. Do you think that appeals more in today's noisy, volatile, uncertain market than it did 10 years ago?
Every investment philosophy and strategy has periods when it underperforms. It's not a crystal ball. But what it does do is it complements other investment strategies and investment styles beautifully. And so having one of your pillars in your investment holdings being unemotional and rational and objective, I think is a really important pillar to have.
So, Rademeyer, I want to finish with this. When you look ahead to the next 10 years, to the next decade, what do you want the fund to be known for?
Jeremy, I would want the fund to be known for its continuous improvement and innovation of a sound intellectual framework for investing. And then I would want the fund to be known for its discipline in keeping emotions from corroding that framework. If that is the outcome and the performance that I believe will come as a result of that is what I think it will be, I'd be very happy.
Happy anniversary. Thank you very much.
STANLIB Asset Management Pty Limited is an authorized financial services provider in terms of the FASE Act. This content should not be construed as advice.